This is a case study of American Chemical Corporation presented by ACC. How would you assess the past performance of American Chemical Corporation? ACC was a diversified chemical company in the United States. They were one of the largest chemical companies at the time, behind DuPont and Union Carbide. Their sales steadily increased from the year 1974 to 1978 from about $4.82 billion to $5.42 billion. Over that period of time, net income dropped in 1975, but it did steadily increase for the next 3 years. Earnings per share followed the same trend, but dividends per share did increase from $1 in 1974 to $1.80 in 1978. They had strong stock prices that increased from 1974 to 1978, with only a minor decrease in 1977. Their total capitalization was also increased from $2.014 billion in 1974 to $2.527 billion in 1978. Because all of these factors increased overall, the company seemed to be growing at a steady rate. This is always attractive when assessing the performance of a company. Another positive indicator of the quality of past performance is the fact that they were looking to make acquisitions. Even though they were met with opposition, they did have the financial ability to expand their business this way. What is your interpretation of the competitive environment of ACC and Collinsville plant? Based on the facts of the case, there was a high level of competition in the industry that ACC and the Collinsville plant were part of. When ACC attempted to acquire Universal Paper Corporation, they were met with opposition. Universal even went as far to sue ACC, claiming a violation of the Clayton Act of the U.S. antitrust laws. Their basis for these claims was that they were both producing sodium chlorate, and an acquisition would significantly reduce competition in the industry. Because this was a federal case, the government intervened and sought an injunction to block ACC's offer. Before this process could continue, ACC decided to take action and agreed to divest its plant in Collinsville, Alabama, where they produced sodium chlorate. This was crucial to the success of this process, and ACC was able to acquire 91% of Universal shares. The fact that Universal and the government went as far as to take ACC to court shows that ACC held a large percentage of the market share. It also indicates that there may not have been a large number of competitors in the industry if one company acquiring another would significantly reduce competition. What is the unlevered and levered beta for Collinsville plant? To find the unlevered and leveraged beta of the Collinsville plant, the betas of two comparable companies must be evaluated. Exhibit 5 in the case provides an overview of the financial statements of sodium chlorate producers. Of the 6 companies listed, Brunswick Chemical and Southern Chemical are the most comparable to Collinsville. The other 4 companies are all significantly larger. Brunswick and Southern are also similar to each other. Therefore, they will be used in calculating the betas of Collinsville. The calculations to unlever the betas and average the 2 companies were done in an Excel spreadsheet. The results of this unlevered beta of Collinsville and this beta that had been leveraged. The unlevered and leveraged beta for Collinsville were 1.035 and 1.593 respectively. To estimate the cost of equity, cost of debt, and the weighted average cost of capital appropriate for the evaluation of the incremental free cash flows associated with the Collinsville plant project, CAPM is used. The formula for CAPM is the risk-free rate plus beta times the market risk premium. The risk-free rate and market risk premium for the case were given at 9.5% and 7.5% respectively. The formula also requires the leveraged beta calculated above for Collinsville. The cost of debt is calculated based on information given in the case, that the interest rate used for the bonds that would be used to finance the purchase price. This rate was 11.25. Finally, the weighted average cost of capital is calculated with the formula the debt ratio times the cost of debt plus the equity ratio times the cost of equity. The weights for D and E are also given to be 35% debt and 65% equity. The actual calculations and results are shown here. The Collinsville plant has a weighted average cost of capital of 16.3%. To project the cash flows of the Collinsville plant without the laminate technology, most of the information was given in the pro forma financial statements in the case. This statement only projected years 1980 to 1984. For the remaining years of the analysis, 1985 to 1989, assumptions were made. These were the assumptions and the reasoning for each. Capital expenditures for years 1983 to 1989 will be $600,000. The case states that capital expenditures after 1979 are expected to range from $475,000 to $600,000, and from 1973 to 1979 were primarily maintenance and pollution control. In 1979, the plant was basically in compliance with all environmental regulations. Going forward, capital expenditures would primarily be for maintenance, therefore, it will not change after 1983. Depreciation from year 1983 to 1989 will increase by $60,000 per year. Exhibit 8 in the case shows this increase in 1984, and the note attributes this to the written-up value of the Collinsville plant to $10.6 million. Accounts receivable, inventories, and accounts payable from year 1985 to 1989 will increase by 8%. This is also based on the note on the exhibit of the case, which states that prices are assumed to increase annually by 8%. Operating profit margin will increase by 0.5% after 1984 because that was the increase from 1983 to 1984. This information was used to calculate the free cash flows of this project, and then these cash flows were used in this terminal value approach. The result was a net present value of $12,847,000. To project the cash flows associated with the 1980 investment in laminate technology, assumptions were also made. These are the assumptions and the reasoning for each. Cost of power from year 1985 to 1989 will increase by 12%. This is also based on the note on Exhibit 8 of the case, which states that power costs are assumed to increase annually by 12%. Power cost savings will be 17.5%. The case states that the savings will range from 15 to 20%. The savings at both 15 and 20% were calculated and the average was taken. Cost of graphite for year 1985 to 1989 will increase by 6.5%. Over the 10-year period from 1974 to 1984, the cost of graphite increased by about 6.5%. This amount will be saved each year following the installation of the laminate in December 1980. The cash flows calculated with this information were used in terminal value approach 2, shown here. The net present value of the Collinsville plant with laminate technology is $4,366,000. In conclusion, I will be answering these questions about the case. What range of value do you estimate for the Collinsville plant? Is the Collinsville plant proposal attractive on economic and financial grounds? The suggested purchase price for the Collinsville plant is $12 million. This seems high based on the financial information provided for Collinsville. A more appropriate range would be between $8 and $10 million. The proposal is attractive on financial grounds as long as the investment is made in the laminate technology. Assess the strategic issues associated with the proposal. Is Collinsville attractive on strategic grounds? Collinsville is attractive to Dixon on strategic grounds. They have a strategy of supplying chemicals to the paper and pulp industry. The ability to produce sodium chlorate would complement their existing product line. They have also already done business with major customers of Collinsville, so the potential customers for their new venture in sodium chlorate would be their existing sales group. As an independent consultant, make appropriate recommendations to the Dixon Corporation's management with regards to the Collinsville plant. My recommendation would be for Dixon to acquire the Collinsville plant with laminate technology. Acquiring the Collinsville plant would be beneficial strategically. For the acquisition to be beneficial financially, they will need to include the laminate technologies. Can Dixon meet all of its financial obligations? If the proposed financing plan is accepted and Dixon acquires Collinsville. As long as the acquisition is managed well, Dixon should have no problems meeting all of its financial obligations if the proposed financing plan is accepted and Dixon acquires Collinsville. Thank you.